Good morning. It's Tuesday, the 10th of December, and this is Govindraj Ethiraj, headquartered and broadcasting as well as streaming from Mumbai, India's financial capital. There is no take today because we've got lots of stories and conversations. Markets slide once again as the cues vanish. The Reserve Bank of India's new governor is an IIT engineer. Car sales fall despite unprecedented discounts at dealerships. The investment case for PSU or public sector unit stocks. And why 2024 will go down as the warmest year ever.
This is the Core Report with Govindraj Ethiraj.
The markets struggle to find cues. A rocking Wall Street over the weekend could not lift spirits on Dalal Street, which drifted lower after struggling somewhat to stay in the green. While foreign portfolio investors are now more active in the markets, including putting out bullish equity reports, it does not look like there is a surge of buying yet and may not be until next month, for the simple reason that the second half of December usually sees activity levels reduce as traders go off on presumably well-deserved holidays. On Monday, the Sensex and Nifty ended the week's first trading session lower, with the Sensex falling 200 points to close at 81,508, and the NSE Nifty 50 settled down at 24,609. That's down about 59 points from its previous close. On the other hand, the Nifty Mid-Cap 100 and Nifty Small-Cap 100 were higher by about 0.5% and 0.2% respectively. So broadly, the mid-cap, small-cap indices are now moving in a different direction from the large cap. Now, shares of Godrej Consumer Products fell about 9% on Monday. That was their worst day since March 2020, according to Reuters, which also dragged down other fast-moving consumer good or FMCG stocks after it warned, that's Godrej warned, of stress on demand and profit margins in the third quarter. The stock fell to its lowest since January 18th, its biggest one-day percentage drop since the onset of the pandemic, says Reuters. Now, if there was hope that the second quarter slowdown was an aberration, then Godrej's commentary suggests it was not and therefore will take some more time to turn. This is also the first specific pointer from a large FMCG company for the third quarter, as I could see, and does not obviously portend well for the rest of the sector, as well as overall consumer demand trends, particularly in the urban segment that many consumer product companies have been referring to as slowing down. The Reserve Bank of India gets a new governor. While the government of India, in its inimitable style, kept the suspense running till the end, it was quite likely that Shaktikanta Das was unlikely to get a fresh extension as the Reserve Bank of India governor. The 67-year-old Das had already served 6 years at this point and had retired from government earlier. It was logical in some ways to expect a younger face to take over, which appears to be the case with the incoming governor, Sanjay Malhotra, who's currently serving as the secretary in the Department of Revenue at the Government of India. His tenure starts on 11th December, that is tomorrow, and will last for 3 years, as is the case with all Reserve Bank of India governors per stint. Das was already the second longest serving governor and had been around for 2 stints. Malhotra is an IAS officer or Indian Administrative Service officer of the 1990 batch from the Rajasthan cadre, holds, like I said, a degree from the Indian Institute of Technology in Electrical Engineering, Kanpur, and he's also a master's in public policy from Princeton University, according to Business Standard. So what can change with the new governor? Well, for one, it's too early to tell, but we will get you some views tomorrow. While there have been murmurs about Das digging in his heels on lowering interest rates, it also seems unlikely that he had that much institutional freedom to start with, at least in comparison to previous governors. Das has definitely been the steady face of a steady Reserve Bank of India, both within, as employees point out, and externally, which is conservative without being ancient. Under his tenure, the rupee has held steady, making it one of the most steady currencies in the world in recent years. He did not fall prey to the crypto mania or other such temptations. More significantly, he's been quick to recognize the froth in the borrowing and lending markets and tightened risk weightages for banks and non-bank finance companies, particularly for unsecured loans. He also came down heavily on erring finance companies, including some fintech companies who thought they could get away with a lot thanks to their advertising spends and self-perceived clout. While India could surely benefit from lower interest rates, I can say with some history and intuition that interest rates are not as defining an issue here as they are in other developed markets, which is not to say that we do not want them to be lowered. The Reserve Bank of India could surely beef up some of its early warning and data capture systems given the problems with data elsewhere in the economy. Remember, the Reserve Bank of India was talking of a 7% growth rate in the last quarter, and that turned out to be 5.4%. Now, this is not to lay the blame on Das's door as he closes it behind him, but to present a challenge to the incoming governor, among other challenges that will surely follow. An investment thesis for PSU stocks. In the last few years, one category of stocks that's done quite well and beyond expectations is public sector units or PSU stocks or state-owned companies. Now, the run-up in the markets overall and these stocks has also led to concerns of stretched valuations, particularly in defense stocks, among others. But the larger bet on PSU stocks has been really based on the government's hard thrust on public spending, which has been quite visible in recent years, including in areas like infrastructure and, of course, defense. A new report from brokerage Elara Securities makes a strong case for continued investment in these PSU stocks. Now, that case is, of course, dependent on a bunch of premises which are worth debating. Principal amongst them is the government's ability and propensity to maintain a high rate of public spending, particularly since for various reasons, including elections this year, spending has slowed down. Also, and quite importantly, the economy itself is not looking as robust as it was 2 quarters ago. Finally, within PSUs, is it purely a monopoly situation like in the oil, gas, and refining companies that make a good investment thesis? Or do these companies have more intrinsic value, including in management capability, apart from business prospects? I put all of these questions to the author of the report, that's Garima Kapoor, Senior Vice President and Chief Economist at Elara. And I began by asking her, why a slice like PSU stocks as opposed to other vertical stacks like energy or defense or something else?
Over last 3-4 years, particularly post-COVID, this government has worked towards policies that have actually driven the top line, that is a revenue, and driven the profitability of PSUs. Because capex spending has been the forefront or the core policy of this government, the biggest beneficiaries of either Atmanirbhar policy or the aggressive capex spending have been PSUs. However, lately, especially since last 7-8 months, there has been a significant slowdown in government's capital expenditure. It's degrowing by 14% till November this year, raising doubts whether it is still worthy to own certain PSUs in the thematic space or the thematic fund space. Or is it still worthy to have a view on the positive PSU asset cycle? And those questions actually drove me to deep dive into the PSU asset cycles and the history for last 24, 25 years.
And what you're seeing now, as you say, is that there is clearly very high public expenditure and public spending, which is going into areas which are typically dominated by PSU. So, in a way, that brings me to my second question, which is that is there a bias here towards monopolies, businesses, or companies which are typically state owned and areas which are more state controlled, for example, defense and energy, oil and gas?
So effectively, Govit, you can define the central public sector enterprises. The growth drivers can broadly be defined into two simple segments. One, that is driven by policy continuity of the government. That is, if the policy of the government is defense and indigenization, then defense PSUs will do well because they will get bulk of the orders. One. Other is the spending. Now, spending is basically a function of how much you are allocating as your capital expenditure on the budget day in the central government budget. And that drives certain sectors like, let's say, railways, because railways is completely owned by a government of India. And then there are certain, those who enjoy the benefit of policy continuity or stability, as well as spending, and probably the vision that probably drives India's growth metrics over the next 10-15 years, and that is power. Because India's peak power growth is going to be rising by 6-7% CAGR, because we are investing so much into renewable energy, government drives the national renewable policy and it has set its target. So the PSUs in and around that ambit also become another aspect to look at. So you could broadly divide as pure policy, policy plus spending, or simply pure spending like railways.
Got it. One of the things about obviously public sector units or state-owned enterprises is that they are run by the government and therefore decisions have to go back and forth, particularly maybe larger decisions and decisions involving larger capital expenditure and so on. Do you factor that in when you look at, let's say, what kind of growth a company could see or decisions a company could take for its own betterment?
Yes, obviously, one of the reasons some funds do not like to own public sector enterprises because they do not like to own the space that has anything got to do with too much of dependence on the government because they fear government instability or they fear lack of continuity of policy approach. However, one hallmark of this government under Narendra Modi has been that they have made PSUs the drivers of growth by basically also undertaking measures that have made them operationally efficient. For instance, in 2022 financial year, the government included in the MOU structure. Now, MOU is something that every central public sector enterprise signs with its respective department or ministry in the government of India, and certain goals or benchmarks are set of what you need to achieve. Now, basis those benchmarks, the PC, CPSCs are performing, and then end of the year, they evaluated basis whatever benchmarks were set out for them. If they overachieve whatever was set out to them, they're rated as excellent. Or if they underachieve, they rated as very poor. So you have CPSC's rating, this is MO parameters like very poor, poor, excellent, very good, so on and so forth. What we see is since 2020, that was the year even before the government spending started, that is financial year 2020, the poor rated CPSCs topped out and they started to fall. And the good rated CPSCs, which were falling, chuffed out and they started to improve. So we are seeing some bit the operational efficiencies of CPSCs also get better. Simple statistics like output per employee, which basically defines the productivity of CPSCs, that has seen a staggering 50% growth in 3 years. And the last data point that evaluated was FY24. So policies like voluntary retirement, hiring more contractual labor, all of that, and consolidation, of course, in the public sector enterprises space has really worked. And then if I look at something like other efficiency parameters like asset utilization ratio, the asset turnover of CPSCs, which used to be about 0.9 to 1 anywhere between FY15 and 16, that has steadily improved to 1.5. So that means you are improving your ability to utilize your asset, number one. Your profitability is improving. Number three, your operational efficiency is also kicking in. And all those parameters that you normally define CPSCs as, like to be inefficient, to be underproductive, etc., are also seeing a turnaround.
But you're also saying, in a way, that because these companies are in businesses where, let's say, they either have a clear tailwind, like State Bank of India is in banking and competing with others, but it also has obviously a rich history of scale and size and so on. Or they're in businesses like oil and gas, or there are companies which are linked to defense production or to railways, where the competitive market is severely limited. So you're saying one way or the other, the prospects are good because either the competitive market is limited or there is tremendous, let's say, legacy strength.
To put a little differently, while I agree to this, I will just maybe put the same statement a little differently and probably I'll reword it. I'll say some of the CPSCs in some of the sectors able to compete with their private peers despite it being expected that private peers will outperform. For example, today, when the liability is one of the biggest questions, how does a liability franchise or how does a bank garner deposits when deposit growth has been lagging credit growth? Something like SBI with a very strong deposit franchisee and with a very strong CASA will tend to outperform its peers, whether public sector or private sector.
As you look ahead, what do you see as the fast growing sectors or stocks within that? And what's the downside? Because we started out by saying that public expenditure is a big driver. And we've already looked at growth coming down in the economy to 5.4%, which we've discussed already. So, in that context, do you see public expenditure staying where it is? And if it goes up or down more likely, then will all of this or a lot of this argument still hold?
My core argument of the strategy report that I worked is to prove as to why the government capital expenditure cycle has not yet peaked out. As a simple rule, the asset growth cycle of public sector enterprises drives its earnings. And the asset growth of public sector enterprises lags the government spending on capital expenditure by 2 years. So if the capital expenditure of the government remains firm or rather continues to grow, there is a continued visibility as to why PSUs will do better. Now, one big reason, notwithstanding the sluggish spending for so far this year because it was a election year, as the government moves away from fiscal deficit as a fiscal anchor to something like get GDP, what will happen is that so long as the rate at which it adds debt every year remains below the rate at which its GDP grows, the debt GDP ratio will continue to consolidate, leaving it a room to be able to maintain fiscal deficit in the broad range of 3.5 to 4.5%. So, according to my estimates, even at a very, I should say, conservative 10% nominal GDP growth, taking revenue receipts lower than what they are currently in terms of growth, and maintaining a consistently 8% revenue expenditure, Government of India can reduce its debt GDP ratio comfortably from 56% by 10 percentage point by the end of FY40, yet spend on its capex something like 3.3% currently in FY25, that is as per budget estimates, to 3.7% end of 30 and all the way to 4% in FY33. So what happens is that moment you move away from targeting a specific fiscal deficit as a target and start targeting debt to GDP ratio as a consolidation anchor, it automatically starts to open up space for you to be able to spend. So, in my estimates from now till for 2040, you can stay in fiscal deficit anywhere between 3.5 to somewhere about little over 4% by that matter.
Right. And you're assuming some sort of linear growth in tax collections and overall government income.
So I am assuming the current tax, the revenue receipts of the government, X of borrowing, are growing at somewhere about double digit 12 to 13%. I'm assuming a very modest growth of about 8%. So I'm being very conservative.
Okay. Before we go, we spoke last week and you had projected that the Reserve Bank of India will not cut interest rates and instead cut cash reserve ratio for banks. So now that's happened. And what's going to happen next?
That's happened partly also because that was the only route where you could address growth and still manage your external sector risks and manage the rupee. Next is that you will see a rate cut in 25 basis points.
Okay, that's pretty precise. Garima, thank you so much for joining me.
Thank you so much, Govind.
Car sales swing down. India's automotive sector continues to face growth challenges. The good news in some ways is that inventory levels are finally falling at dealerships to around 60 to 65 days after crossing about 80 to 85 days, which is obviously or was a record. The ideal inventory level, as you will hear shortly, is about 21 days. So there you are. Passenger vehicle sales fell by about 13.7 or close to 14% for November, while commercial vehicle sales were also down about 6%. Data from the Federation of Automobile Dealership Associations, which represents over 30,000 dealerships in India, has said two-wheelers did better, growing about 27% month-on-month and 16% year-on-year, achieving record high November registrations that also were higher than November 2023, but the industry was expecting more, including thanks to the wedding season, which has kicked off. The industry is also grappling with a fundamental problem. Honda Cars India President and CEO Takuya Tsumura highlighted weak consumer sentiment and increasing discounts driving artificial demand in the market, or essentially saying that all these cars would not really sell if the discounts were not there, and the discounts, as we hear, are at never seen before levels. Mr. Tsumura also noted in a report in the Economic Times that the industry has excess stock, which is contributing to the lower actual demand compared to last year. According to him, demand was a whole month behind, which is give or take about 330 to 350,000 cars. Now, there is another aspect, which is finance and what appears to be the tightening of it, as we've seen elsewhere as well. I reached out to FADA President C S Vigneshwar, who's based out of Coimbatore, and I began by asking him how he was reading the Honda CEO's statement about sales largely being propped up by discounts, before asking him for the overall trends that he was seeing towards the end of the year.
Today, a lot of consumption is happening because of loans, because availability of finance. So that today people are looking at EMIs rather than anything large. So I think that sentiment holds good in anything which is financeable, if I can call it that way. I'm sure it's similar in cars too. So I would look at as a area where the stocks are high and stocks are a direct relation to the discounts available. And today we are having never ever seen before discounts available in the auto sector, especially in the PV segment, for a single reason being our stocks are high and we want to offload stocks. But the good thing about it, if I can see a light at the end of the tunnel, it will be that the last 2 months, the stocks have been coming down. Even last month, the stocks have dropped about 10 days compared to the previous. So I think manufacturers are taking cognizance of the situation, but still we are at about 65 days stock, which is crazy. Because for us, we in the industry, we think 21 days stock, it would be the perfect stocking levels given the kind of inventories we have, given the kind of margins we have. So 21 days stock would be the healthy stock. We are still far away from it. I agree with what MD San had said from Honda. It's discounts are driving the market at this point.
When you say never ever seen discounts, I mean, can you give us some proportion or percentage? I mean, what are you comparing it with?
I don't know cars out there.
So, on a value, for example, what is when you say never, I'm assuming you mean value. So, let's say 1 lakh off on a 20 lakh car, for example. So, that would be.
That would be good enough. Yes, that would be something which is available in the market, right?
On the inventories, you said that basically you're at about 65 days, if I've got that right, which is still about 3 times what you should be holding. Last point from the Honda managing director, he said that we are running a whole month ahead, which is almost 330,000 cars for the industry.
Our whole life is running a few quarters ahead. We end up buying a phone on EMIs. We end up buying the car on EMIs. So, I mean, this has been a factor of the last couple of decades. So, and it's becoming only stronger in the last couple of years. More and more people want finance. The accessibility to finance is higher. So, finance is really helping us actually drive the market.
Is there a positive side to this, which is that inventories are coming down, which means manufacturers are reducing their production? And therefore, what they send you next, which is maybe a quarter or so down the line, I don't know if there are new models, but newer cars, or at least in the new year, could that change things?
It could, but this correction has to happen faster. One of the reasons also would be that November was a little bit tepid and it was disappointing is quite a few of the customers actually have shifted their requirements December, anticipating higher discounts. So now the higher discounts are available. So we're expecting these customers to come and pick these cars off our lots. So that has to be combined along with a reduction in stock by a reduction in wholesales. So when this happens, when both of these two happens, probably is going to be a better place where we'll be sitting in 1st of January.
Now to come to November, there has been some confusion, at least for people like me who are looking at it from outside, because, we were pegging a lot of demand trends around the festival season, which itself was not strictly comparable because the dates differed from the previous year, which is 2023. So where are we today as we speak in the first week of December? Are we able to see a normalized sales number?
This month will look good, according to me, because October was great. Even the 42-day period which we took, we also released numbers last month, in the middle of the last month, and that was also looking strong. But November was again a little bit weak because in passenger vehicles, we recorded a minus 13.72% degrowth. So there was a degrowth. So a lot of it is because people are waiting for the December offers. And has become traditionally, people used to actually jump to January saying that I don't want the older model. But now, last 5-6 years, people have actually seen value in actually picking up the car in December at a good deal.
What's your sense of, the overall festive plus weddings? I mean, I think your official position is that it's not been so good. So what was the expectation then?
November was below expectations. So this below expectations is going to be, we're expecting it to spill over into December in terms of retail.
At which point it could pick up. Okay. So, however, two-wheelers have done well. How does that contrast or does that make up in any way for the industry as a whole?
Two-wheelers are doing really good for the last year. And they've only been building up momentum. And what we saw last in terms of month on month, it was a 26% increase, and year on year, it was a 15% increase, 15.80 to be exact. And a lot of it is actually coming from the rural areas. The rural area right now, last month, it was crazy. Usually it is the rural areas contribute about, 55, 56% around. But last month, they jumped to nearly 64% of contribution compared to urban rural split. So I think that was a huge revelation. And that was actually coupled with the fact that there was a nearly 29.88% increase in tractor sales year on year. So which means that the Bharat of India is doing really well and it's actually becoming a locomotive to drive the economy. Having said that, the harvests have been good. So there's a lot of positivity in the rural segment. Apart from that, we also have seen that a lot of the minimum support price for a lot of crops have also got up. So this also helped. Whilst Bharat is great and we're quite happy for it, we're also seeing that urban India lose a little bit of steam. This one example I would give you is that in 2020, the average cost of a car was 6.5 lakhs. The average cost of a car today is about 10.5. So for a 70% increase in price, and this has happened for various reasons, including, it is coming in and road taxes being increased certain places. But has salary gone up to the same extent? It hasn't. I mean, it won't. So there is some kind of a pressure in the discretionary spending in urban areas as well as inflation pressures. So it'll be great if the government actually can take cognizance of this and actually start reconsidering the GST for entry-level two-wheelers, entry-level four-wheelers, passenger cars, because these entry-level products are not anymore luxury products. They've all become really utility products where people want to utilize. It's a need. It is not a luxury anymore.
Any broad trends that you're seeing? I mean, when I say you, I mean you as a dealer yourself and as you visit your showrooms, people, anything that you've been picking up in terms of what people are looking for, what's exciting them?
Elements are still decent. The finance availability is good. Offers are high, but these offers may not last for long. So these discounts won't last forever. This is the last hurrah, if you ask me, because this sales, high stock is going to be a last hurrah for discounts and be a great time to go and pick up these vehicles by customers. But after that, believe me, in January, Feb, March, things are going to start tapering down.
And some manufacturers are already saying they're going to increase prices.
Quite a few of them are increasing prices, so which means that there's a good time to go and pick the vehicle up right now. Because price hike is something which is inevitable. Inflation will lead to input costs rise and they'll have to factor it.
Right. Vignesh, thank you so much for joining me.
Thanks, good. Take care.
24, the warmest year ever. This year will be the world's warmest since records began, with extraordinarily high temperatures expected to persist into at least the first few months of 2025, scientists at the European Union said on Monday in a report in Reuters. The data from the European Union's Copernicus Climate Change Service, or C3S, from Jan to November had confirmed that 2024 is now certain to be the hottest year on record and the first in which average global temperatures exceed 1.5 degrees Celsius above the 1850 to 1900 pre-industrial period. The previous hottest year on record was 2023. Extreme weather, according to the Reuters compilation, has swept around the world in 2024, with severe drought hitting Italy and South America, fatal floods in Nepal, Sudan, and Europe, heat waves in Mexico, Mali, and Saudi Arabia that killed thousands, and disastrous cyclones in the United States and Philippines. Last month also ranked as the second warmest November on record after November 2023. Copernicus climate researcher Julian Nicholas told Reuters that we are still in near record high territory for global temperatures, and that's likely to stay at least for the next few months. Carbon dioxide emissions from burning fossil fuels are the main cause of climate change, says the report, adding that scientists are also monitoring whether the La Nina weather pattern, which involves the cooling of ocean surface temperatures, could form in 2025. Now, that could briefly cool global temperatures, though it would not halt the long-term underlying trend of warming caused by emissions, and the world is currently in neutral conditions after El Nino, that's La Nina's hotter counterpart, ended earlier this year. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.